Estate has been a fascinating one in terms of what kinds of properties not only continued to work during the pandemic, but really soared, and others that got hit pretty hard. Let's bring in Jeff Olin, he's the CEO of Vision Capital. And Jeff, I want to start right there. I think there might have been some surprise throughout the pandemic, at least in the initial innings, about how well residential real estate has done through all this.
Yeah, of course, it depends what part of residential you're talking about. In terms of single-family homes, there's been record sales everywhere in North America. I mean, folks are looking whether those that do have a job, they're not going on vacation. Their Amex bill is, their Visa bill is 2 pages, not 12. They're focusing on quality of life and perhaps work from home environment. So single-family homes have done well. Single-family rental homes, which is a big sector focus for us, has done extraordinarily well. This was a sector that was doing well before the pandemic. But you've seen a transition from apartments away from common areas and elevators to single-family rental homes where you can actually rent them at a lower rent per square foot than you can in apartments. So residential has done well. Apartments have been a mixed bag. I mean, you see coastal apartments in the United States, New York, San Francisco, LA. Occupancies are plummeting. Rents are down 31% in San Francisco, whereas the Sun Belt looks pretty good.
What's your longer-term vision in terms of that residential apartment space? Because we do know, and it's in urban centers here too, in Toronto, rents are down 13 to 15% year over year in the downtown cores. But there is optimism when I talk to people who are investors in that space, that by the spring, the vaccine, the reopening of the economy, that should start to rebound. Is that timeline a little tight?
No, I think, what we do at Vision is we're focused on publicly traded real estate securities, and we compare the underlying value of the real estate that is implied by stock prices to what is trading at in the private market. And what you're seeing, to your question, and there was an article in this morning Globe and Mail to this regard, where you're seeing record prices for apartment transactions, like 2 and 3% unlevered returns, or cap rates in real estate speak. Whereas the stock market, you can buy REITs like CapREIT, for example, at a significant discount to the value. And this is not something you see very often in public markets. So the sector has benefited for years from immigration. That's driven the gap between in-place rents and market rents. Clearly, immigration has been off the table this year, but everybody wants it to come back. It will come back. And so folks are looking through the next few months to underwrite the long-term value in apartments, particularly in places like Toronto and major urban centers that are buoyed by this immigration and positive factors in a sector that's seen very little new supply.
So, Jeff, let's talk about a couple of names then that we can look at. And I know one of them in the United States is Tricon. It's a name I think that so many of our viewers are quite familiar with. But what's the latest with that company? Why do you like it?
Well, 70% of their net operating income comes from single-family rental homes. And we spoke about that a few minutes ago. A sector that was doing well and is benefiting from the pandemic, but won't have a disbenefit, if you will, when the pandemic goes away. So we like that name a lot. It's very solid management. In August, we had the privilege to participate in a transaction that Blackstone led with a $250 million exchangeable preferred share investment in Tricon. What's notable about that is Blackstone was a pioneer in this space. They actually sponsored the creation of the largest player in the space, Invitation Homes, which has 80,000 homes. They took them public. They sold down this position, concluding in late last year. And so for them to re-enter the space through Tricon, if you read the press release from the CEO of Blackstone, said this is a best-in-class operator. We agree. Stock is cheap. It's 20% below net asset value. And so this is a sector that is really solid. Demographics are supporting it, and we like Tricon a lot. And there's some catalysts there in the near term with selling down their apartment portfolio and paying down a bunch of debt.
I want to get your take as well on BSR REIT. What's the story there?
BSR REIT is a top holding. Like Tricon, it's one of the select Canadian REITs with virtually, in BSR's case, 100% U.S. properties that is traded only in Canada. So they're off the radar screen for American investors, and they're not as well as understood because they're American properties to Canadian. BSR is in apartments, affordable apartments in major Sunbelt markets experiencing significant demographic factors, population growth, employment growth, It's affordable apartments, $900 a month rent, so you get offense because of the employment growth and population growth, and you get defense because they're at the affordable side. Everybody needs to live somewhere. Again, trading at a 20% lower value than the value of their apartments on the Toronto Stock Exchange. A nice 5% dividend while you wait in BSR. Management is outstanding, and they own and control about 40%. So it's not externally managed like many of these U.S. REITs that are U.S. entities that went public in Canada. It's internally managed with solid alignment from really solid, best-in-class management.
We got a few other names on your list here. RioCan obviously just cut their distribution. This is a tough time to be a retail landlord. Longer term, do you think things turn around for them?
Yeah, so we've been short retail generally for most of the last 5 years. But not only do you have to look at fundamentals, you have to look at valuations. And so RioCan and other names got really beaten up in terms of the stock price. We stress tested it. We thought that the stress tested value was probably around 16. We bought some at 14. We bought some at 16. We expected them to cut their dividend. We thought that would be a positive catalyst for the stock. Friday, they announced the cutting of the dividend. The stock plummeted at the opening from around 18 down to 16. It didn't last very long there. We bought some more stock on the way up. So for this is a shorter term investment for us, but solid management. They're going to have the finest apartment portfolio in the country in 5 years. It's not that meaningful in terms of the scale of the retail, but it's still significant. We think some of these retail names probably have some value in a contrarian perspective today.
Jeff, I've just got a follow-up, a different kind of question, I suppose. I'm curious, with all the interest and focus on automobiles, the increase that we're seeing in terms of demand, and even as it relates down to the semiconductor chips, do you have an interest at all in some of the automotive properties like APR? Is that on your radar?
Not really. We think, there's some solid people there, but they're not the most aligned. You're leasing, the landlord and the tenant are one and the same in many cases there. It's not a preferred name for us for those reasons. It's, not a great name for us.
All right, Jeff, I feel like we just scratched the surface on some of your ideas. I'll have to have you back soon, but thanks for joining us and sharing them with us.
Thanks for having me. Have a good afternoon.
To Jeff Olin is the CEO of Vision Capital.